SOFI just posted a record-breaking quarter, and at one point the stock found itself up over 17% at $25 a share after they released their Q2 2025 earnings. However, in true SOFI fashion, in the pre-markets on Wednesday, the stock found itself down over 7%. And in this video, we're going to be discussing what it means for the company. Do I really think that this is the same old pattern repeating itself, or are there potential opportunities in front of the company in the coming quarters ahead? But more importantly, what I'm planning to do with my position, because in their most recent earnings, I believe SOFI actually answered a burning question that I had over the last couple of months that could affect how I value the company for the rest of the year. But as always, potential is a dangerous word, so let's dive in. I just want to start by saying that SOFI absolutely blew every single one of my revenue and profitability metrics out of the water, but in many other aspects of their business, we actually came in much closer than expected when it comes to our projection versus the actual numbers that the company put up. And we're going to discuss the implications of that in the rest of this video. You see, if you remember in my previous video, I said that SOFI actually had three levers to pull in order to drive revenue growth. And these three levers were basically member growth, product adoption, as well as monetization. And on two of the three counts, I was actually pretty close to how their business perform. But where they blew me out of the water, like I was saying, is their ability to monetize their products, which drove revenue as well as profitability. But we'll get to that in a bit, because first I want to shout out the bunch of you who absolutely loved the fog down in the comments below. I really have no idea what's the big deal about this fog, but you know what? Due to popular demand, it is back again, and if you like and subscribe, perhaps you may see more of this in future. You see, the thing I really like about companies and about management teams is that when they give us certain projections, certain estimates, they actually come out and deliver. Now, Anthony Noto has been saying over the last maybe 1 to 2 years that eventually SOFI will be growing their member counts between 800,000 to 1 million members per quarter. And this is the first time that we are seeing net new members added per quarter fall within the 800,000 to 1 million member range. Now, in Q2 of 2025, after accounting for churn, SOFI added 830,000 new members versus my own estimate of 824,000 new members. On a quarter-over-quarter basis, this was actually fairly consistent. I'm growing in the mid 7% range, coming in at around 7.5% quarter-over-quarter. And on a year-over-year basis, they actually came in at a 34% year-over-year growth. Now, if SOFI keeps growing their member counts at these growth rates, around 7.5% quarter-over-quarter and 34% year over year, then they're basically projected over the next 3 quarters to hit 1 million net new members by sometime around first or second quarter of 2026. Now, if you ask me, Elijah, how do I know whether this pace of growth in terms of their member count is actually sustainable? You just have to look at their marketing efficiency. You see, because SOFI themselves like to talk about unaided brand awareness. Now, as someone that is outside of the company, they're perhaps using certain internal metrics to measure their unaided brand awareness. So for us, that particular metric can be quite hard to measure. But what we can see is that every single quarter, SOFI spends around 31% of their revenue on marketing, and they have been able to consistently keep their customer acquisition costs down at around the $300 range. Now, in a way, this becomes a virtuous cycle for the company, because as SOFI has more members on the platform, these members are able to then generate a higher revenue for the company. And despite being disciplined in the way that they spend their money on marketing by only limiting themselves to around 30% of entire revenue spent on marketing, because the revenue number is growing, the amount that they're able to spend on marketing is growing in tandem as well. And because of that, they're able to spend more on marketing without affecting their margins. And if their customer acquisition cost remains steady around the $300 range, at least over the next couple of quarters, then they're definitely going to be able to keep up this pace of growth. Now, will their marketing efficiency decline over time as SOFI becomes a bigger and bigger company? Yes, definitely. I think that is something we are expecting moving ahead. But right now, with only 11-12 million members on the platform, I think that is still some time away, right? So I think that is pretty unlikely, which is why I do think that they're able to sustain this pace of growth at least over the next 2 to 3 quarters, so that they eventually hit 1 million net new members added sometime in the first half of 2026. And then we come to the second lever that SOFI can pull in order to generate revenue growth, and that is product adoption. Now, when it comes to the total number of products, I was actually pretty spot on with my estimate. Using 1.46 products per member, I actually arrived at SOFI having 17.14 million products this quarter, and SOFI actually reported 17.142 million products this quarter. So we are basically right on the dot there. So this actually represents a 34.1% year-over-year growth. But I think more impressively is that if you look over the span of the last 5 years from 2021 until today, that represents a 53% CAGR. And so when you really start to dig into the numbers over here in terms of their product mix, I think you can really see where the exciting parts of their business really is. Now, the first thing I want to point out is that the growth of SOFI Invest is picking up. Now, the last 2 quarters was the first time since Q1 of 2023 that this segment of their business grew over 20% year over year. In fact, if you can take a look at their growth rates, especially across 2024, this entire business segment was stagnant throughout 2024. And we know, and Anthony Noto has told us specifically, that the target here is for SOFI Invest to become as big as SOFI Money. But it's not going to be so easy because it's not as if SOFI Money is not growing. SOFI Money is actually growing 37% year over year, which means for SOFI Invest to eventually catch up and become as big a business segment for SOFI compared to SOFI Money, they would have to accelerate the growth of their invest business even faster from here. Now, on top of all of this, you can also see that SOFI took the entire year of 2024 to rebalance their credit card portfolio, and once again, they are re-accelerating growth in this segment, growing at 32.2% year over year. Now, these are 2 business segments that management has already told us before that individually they could become a $1 to $2 billion business within SOFI's entire ecosystem. And then we come to the most exciting part of SOFI's entire business or entire earnings, which is their revenue as well as profitability. Now, in Q2 of 2025, SOFI reported an adjusted net revenue of $858 million. This represented a 43.8% year-over-year growth. Now, this absolutely blew out my own expectations of just $827 million at a 39% year-over-year growth. Now, this $858 million number turned out to be a 6.6% beat over the high end of their revenue guidance, which is more or less in line with what they have done previously. You see, my own estimate only assumes that they beat the high end of their guidance by around 3%, right? But I think before we talk about profitability, it's important to discuss how SOFI even managed to monetize their products so effectively in order to drive revenue growth, because this is exactly the third lever of monetization that I am talking about. So let's break it down by segment. Now, I expected lending revenue to come in at around $437 million. However, SOFI's lending revenue came in at $443 million. Now, if you look just purely at the lending number, this turned out pretty close. But I think where was the main difference is in terms of contribution profit. Now, I expected a 58% contribution margin, which was the level that they were operating at previously. However, this quarter's contribution margin only came in at 55%. Now, although I say only 55%, this is actually still quite a healthy number. And at 55% contribution margin, contribution profit came in at $244.7 million. Now, like I said, although this is lower than the previously reported 58 to 60% over the last couple of quarters, I think you really have to see this in context of what management has told us in the last couple of quarters leading into 2025. Now, SOFI's management has actually indicated before that within their own credit box, they actually still segment their borrowers into 8 different tiers. And over the course of 2024, they actually tightened some of their lending standards and stopped lending to some of these tiers of lenders. Now, with higher quality of borrowers, I think that usually lends to better margins overall. And I believe that as we prepare for rate cuts, as SOFI prepares for rate cuts, they are starting to loosen their lending standards. And so once again, as they accept more borrowers, I think it's natural to see slight dips in margins, but this is nothing to be concerned about. Now, and I think primarily their strong performance in lending is actually driven by this $8.7 billion of loan originations, of which $2.4 billion was originated on behalf of third parties. Now, I also want to note that I think there are certain increases in net charge-offs related to student loans, but during the earnings call, they actually clarified that a lot of this is down to certain disruption due to change of services, as well as buying a portfolio of student loans that had a higher net charge-off than their own portfolio of student loans, however, still still within their own expectations, and the price that they actually paid is reflective of this net charge-off rate. However, I think for personal loans, this is where we see an improvement in net charge-off rate decreasing from 3.31% to 2.83% this quarter. So overall, if you look at the entire picture, SOFI's credit performance is very strong. And while this is still a very small segment of total loan originations, I just want to point out to you SOFI's home loans over here. If you just take a look with me at the numbers, they actually have around nearly $800 million in home loan originations versus $416 million just a year ago. So they basically doubled this segment of loan originations. Now, I've said this in a couple of videos previously, and I'm going to say it again, that home loans is definitely something to look out for. I believe Chris Lapointe has already told us that last year, right, only 2% of SOFI's existing members are using SOFI for their own home loans, and they plan to cross-sell this product to even more of their existing members. So I believe this is going to be one of the growth drivers for SOFI going forward, and nobody is really talking about it just yet. And this is where we can find alpha in the companies that we look at. And where SOFI really drove monetization is in the financial services side of their business. Now, financial services revenue came in at $362 million versus what I expected, $335 million. And this represented 106% year-over-year growth. And this is another double in this segment of their business. Now, this growth in their financial services is primarily driven by the growth of their loan platform business since Q3 of 2024. Now, SOFI has already told us that they expect this particular segment of their financial services, the loan platform business, by itself to become at least a $1 billion revenue driver for the business going forward. Now, the loan platform business, like I said, by itself also is on track to originate nearly $10 billion worth of loan originations in 2025. And if you consider the fact that, SOFI reject over $100 billion of loans throughout the course of the entire year, they are really just getting started because there is a huge market to go after. And we know from management that in Q2 of 2025 is the first time that their loan platform business is going after part of that rejected $100 billion loan applicants in this quarter. And so even at the current run rate, if you discount the referral fee that they receive from the older aspects of the loan platform business, the current loan platform business that was birthed in Q3 of 2024 is operating at an annualized run rate of $420 million, right? So the $500 million number that you hear during the earnings call is inclusive of all the referral fee. And so I think if you think about it, the loan platform business that was birthed in Q3 of 2024 is basically Upstart's entire business. And when you look at Upstart's performance in the entirety of 2024, Upstart basically generated around $680 million of revenue. And so it is actually not too far-fetched to think that this one segment of SOFI's business, give it 2 to 3 years, I think it can easily eclipse Upstart's entire business. Because when asked about what a good run rate analysts could use to actually project out the loan platform business, Chris Lapointe actually said they don't have a specific run rate that they are using, but he can confirm that they expect an increase in momentum of the loan platform business in Q3 and Q4 of 2025. And to me, that is incredibly bullish. Now, moving on from the financial services side of their business, I want to talk about the tech platform. And this time round, right, perhaps because my own expectations were so low and I was quite pessimistic going into the second quarter about the tech platform, I think they actually did better than I expected, right? Although, like I said, nothing spectacular by any stretch of the imagination, but it's still better than expected. And like we have heard before, I think they have over 10 deals right now that they are currently working on that could actually see revenue recognized in 2026. So therefore, I think I actually only expected $102 million of revenue from the tech platform. However, tech platform revenue came in at $109.8 million. And why this is significant is because the total number of accounts actually only grew by 1.6 million to 160 million tech platform accounts. And if you take a look at the numbers over here, it tells us that SOFI has been able to further monetize the remaining accounts on their tech platform even after Chime left. And the tech platform revenue per account actually increased to 69 cents per account. This is actually the highest number since since Q2 of 2022. And so I believe as they continue to build out their tech stack, as they continue to add on all these crypto offerings through their tech platform, SOFI is going to be able to better monetize the accounts on their platform. And I expect to see this tech platform revenue per account number continue to rise in the quarters ahead. And then we come to talk about SOFI's level of profitability. Now, SOFI reported an adjusted EBITDA of $249 billion. This represented a 29% adjusted EBITDA margin. Now, this easily beats my own expectations of $227 million of adjusted EBITDA. Now, SOFI's net income came in at $97 million. This represented an 11% net income margin with an EPS of 8 cents, again, comfortably beating my own estimates of $81 to $84 million. Now, I was saying $81 million on the conservative side, and if they actually hit a 40% year-over-year growth, then $84 million net income on the more, bullish estimates, and they blew both of these numbers out the water. And I really just want to show you how impressive a company, SOFI really is. They beat their own high-end EBITDA guidance by nearly 19%, and the high end of their own net income guidance by 39%. And I do think that the continued strong performance by the company over the last couple of quarters, in fact, over the last couple of years, has warranted us shifting a little bit our assumptions in our valuations, and I'll touch more on that in a future video. But if we are talking about future projections, I think it's important to remember that the one key metric that we know SOFI's management looks at is actually incremental margins, right? And when I use their Q2 2025 profitability numbers, put it into our valuation process, this actually allows us to find out the incremental margins that they're operating the company at. And looking at these numbers, this actually clarified some of the questions I had about how management will run the business in the years ahead, especially since they have told us that they're planning to drive revenue growth. Because we know that SOFI's management has intentionally limited revenue growth back in 2024, and at the back of my mind, I've always wondered, over the last couple of months, that whether or not coming into 2025, since they're telling us that they're going to drive revenue growth, is there a possibility that they're going to intentionally limit their profitability? And the answer from looking at this is that it doesn't really seem to be the case. Now, management has told us time and time again that they're looking to drive revenue growth for the company above 20% for decades to come, and to do that, they need to keep investing into the business. Therefore, my assumption every time I was doing an incremental margin assumption is that their margins will more or less match their long-term goal of a 30% adjusted EBITDA margin and a 20% incremental net income margins. However, in Q2 of 2025, if you take a look over here, SOFI is basically telling us that they are way more profitable than they expected, and the numbers paint the exact same picture. Because when I plug in the numbers, what you realize is that incremental EBITDA margins for SOFI in Q2 of 2025 came in at 42.6% versus what I was expecting, which is 30%, and incremental net income margins came in at 30.6% versus what I was expecting, which is around 20%. And like I said, this is definitely going to affect how we measure the company and how we actually look at the company's valuation, especially in the next 2 quarters ahead. But like I said, more on that in a future video. And after all of that, after posting their best ever quarter, I guess you can say the most SOFI thing ever happened. Right, over the last couple of quarters, every time SOFI dumped after an earnings, I think you could blame some sort of macro conditions, but this time round, I think many investors are complaining because it seems like management is shooting themselves in the foot by diluting shareholders right after stellar earnings. But I think if you look at the entire situation, it is not that straightforward. Now, personally, for me, I took advantage of the situation, selling 30 cash secured puts at $19 for 29th of August, and I made $1,740. Right, so either way, either I get to keep the entirety of the premium, or I get to buy SOFI below $20. Now, I wanted to add another 1,000 shares in the $20 range early this morning. That would have represented my first buy in the $20 range, but I kind of miscalculated the amount of spare cash I had. So I didn't manage to buy that 1,000 shares. But if we do get a weaker August, I definitely would have cash on hand to add during that time. But I think for us investors, it's important to understand why the stock fell 7%. Like I said, they basically diluted shareholders, issuing nearly 72 million shares at $20.85 per share, with an option for the underwriters to purchase an additional 10.7 million shares. I believe the underwriters are Goldman Sachs as well as Mizuho, right? So I think there has been a little bit of speculation around where this cash will be going towards. I think whether or not it goes towards lending, or I think more likely, personally for me, I think it goes towards an acquisition. I think SOFI's management in general has really earned the right to have a little bit of trust from investors. I mean, after taking us from $6 all the way up to $25 yesterday, I don't think we really can be complaining unless you're one of those that bought the stock between $23 to $25. Now, however, with that said, I do want to acknowledge that I think many investors out there, myself included, feel that if they're going through all of this just to expand their balance sheet to, make more loans or to take on more loans, then there could be better ways to actually do that. And this is where the news gets exciting, because I want to give credit where credit is due. I did not do any of this research. The only thing I did was to go on X and, type in SOFI into the search bar and try to read the latest news over potential acquisitions. And I saw this post. I believe DDI was the one that shared this. This is a post by Nadiv Cohen. I hope I'm pronouncing the name correctly. Now, he basically suggested that there are two possible acquisition targets for SOFI in the crypto space, because that is likely, if you listen to past interviews, that is likely a space that they are looking to expand into in the second half of 2025. Now, these two companies are actually BitGo and Anchorage, and honestly, I haven't even heard of Anchorage even before this post, and I know BitCo only because they are a SOFI customer. I don't really know what else they actually do. Now, basically, I'm going to be leaving the link to the entire post down below, but I'm just going to quickly summarize what he told us in this entire post. Now, Nadiv told us that if SOFI actually goes out and acquire BitCo, one of the advantages is that BitCo will integrate very seamlessly with SOFI's entire ecosystem, right? So this actually helps SOFI become the AWS of fintech. However, Anchorage, like I said, this is a company that I know nothing about. Apparently, they are a federally chartered crypto bank in the US, licensed by the OCC. And the moment I heard this, I just feel like this is really up the alley of, SOFI's management and things that they like to do. They like to be very black and white, and they like to play within regulatory frameworks while still growing at pace, right? So it's different. It's a different strategy from, another crowd favorite like Robinhood. And in his words, this turns SOFI from a bank that offers crypto into a crypto native financial institutions with full legal authority to operate at scale. And like I said, this is really in line with how SOFI's management likes to operate. And I think if you think about it even further, if they make this acquisition, I think you have to include the members on those platforms into SOFI's ecosystem, and with the ability that SOFI has shown that they're able to cross-sell the existing members on their platform, I think you can easily see a bump in revenue and profitability over the coming quarters ahead. Now, it might not be in Q3 and Q4 of 2025, but we know that is somewhere in the horizons. Now, remember how, back in May, I made these two long valuation videos, and I said that this is likely going to be the last valuation video for the year unless something significant changes. Well, if they go out and make an acquisition in the crypto space, adding more new members onto the platform, well, that is something that definitely will change our valuations for the company in the years ahead. And I will definitely be doing an update to that valuation video. And with that, I will see you in the next one.